Welcome to this week's Market Matters video updates. Harry Watt here for Market Matters, joined by James Gerrish on Wednesday, the 9th of February. James, markets have had a very strong bounce out of lows late January, early February. We've just cracked 7,200 today, James. We're going to continue to see this bounce play out, do you think?
Yeah, it looks like a reasonable low in the market. So obviously we've been writing about, we're fully invested across our portfolios. Is probably the first thing to say. We don't have plans to lighten that load anytime soon. So I think the market's probably, I wouldn't be surprised if the market consolidates around this 7,200 level before then going and pushing higher. And I think there's probably a realistic expectation that the market's going to go and at least test those recent highs as well. So if you think about our macro backdrop around our view is that bond yields have potentially peaked for the next couple of quarters at least. So that's positive for some of these beaten down areas, technology and the like. It's not as positive for the banks, but it's positive for some of the beaten down areas, and banks are benefiting from the improving economy. So pretty confident, happy in the market at the moment, which is always a dangerous position to be in, Harry.
Definitely. Reporting season's now underway, well and truly. The big one today, CBA, you got to hang your hat on CBA's result basically every reporting season. It's up strongly. Couldn't crack $100 this morning, but was it a good enough result for your view, James?
Yeah, I thought it was a really strong result. So, cash earnings are about 5% above where we were expecting them to be. Hence the pop in the share price today. I think a couple of things were worth mentioning. Obviously, the dividend is up on the same period last year, which is positive. But the net interest margin is weak, so at 1.92%. But that was very well flagged to the market. So that's why the market's not overly concerned with that metric at the moment. And it's being that's a trend right across the sector. There's an interesting chart in the CBA pack this morning around sensitivity towards interest rates. So a 25 basis points increase in the cash rate, which they're forecasting in August, will improve net interest margin by 4 basis points. So you think about the outlook for interest rates going higher. That has a meaningful impact on CBA's earnings going forward, as long as they don't go too high and we get economic impacts as a consequence. But CBA reading their views around the economy, and they are, they've got their finger in a lot of pies in the broader Australian economy. They've got a pretty good handle on it. They're positive on the momentum that's out there. So I thought it was a good result, and I think it was a good read through on what the Australian economy is producing.
Definitely. One stock we have a lot of questions on, Mineral Resources. They're out with their first half numbers today. James, a whirlwind start for today for MIN. We've seen a bounce out of lows from early this morning. If you're quick enough to get in, do you like the result? Do you see that bounce continuing?
So this is an interesting business. So they have iron ore mining, they have mining services, and they're an emerging lithium company. Some say the cheapest lithium stock globally. So the results today, we don't own it. We've looked at it multiple times in the past. The result today, the headline was a loss. And it's a loss because of their iron ore division. So iron ore prices during the period were weak. We all know that. They came down and benchmark got to near $90 a tonne. Mineral Resources cost base is around that $90 a tonne. They produce lower quality ore. And the discount applied during that period was greater because China was really focusing on efficiency of their steel mills. So they were given the high power costs. So they were favouring this higher quality ore. Fortescue's had the same thing. I think that the key here is looking through this result for Mineral Resources and looking at what they're creating over the next 5 to 10 years. So they're going to create a company that's growing strongly. Their iron ore is going to get a lot more competitive in terms of their cost base. Their lithium exposure is going to grow, and their mining services division is going to be fed by the development of those two things. So for me, it's a really strong growth company. It's sort of around the $55 at the moment. I'm not a buyer here, but if we were, there's been a big buyer of the dip this morning. It was down 10%. It was down sort of 3 or 4% when we left the desk. If it goes and trades into the mid-40s, would be interested in that again, because the growth profile over the coming years is really strong. So one to keep on the hit list there, guys.
Could be a different company in 5 or so years' time, James. Magellan, stock we own. Can't shy away from it. We've written about it a fair bit. It seems every day AFR's got a new article with a different take on this one. Here, is it cheap enough to be looking at and double dipping in this stock?
Yeah, we've got a small position in our income portfolio. We bought at higher levels. It's hurting us. It's one of our worst performing positions in our income portfolio, or right across all of our portfolios, actually. So obviously, Hamish Douglas is stepping aside for medical reasons. The changes that they've made at the in terms of who's running the business, how they're running it, and the structures they're now going to have in place, I think is a positive. I don't think, Hamish was always the front man of Magellan, but there was a really strong team behind it. I put a little comment in yesterday afternoon's note just around Magellan's market cap relative to the funds under management. So their market cap's 3.2 billion. They have about 94 billion under management. So that's a really, it's dirt cheap. So there's no two ways about it. The market's pricing in a lot of outflows from Magellan. So I've always thought, I've always been taught to be buying when there's blood on the streets, even if it's your own. That's what the case is with Magellan at the moment. I'd be, if I had a higher risk tolerance in the income portfolio, this is a lower risk portfolio, we would be adding to it. Because of the lower risk nature of that portfolio, we probably won't until we see signs of a turnaround and some of these fund outflows have ceased, and then we'll look at it again. But for now, certainly wouldn't be a seller of Magellan. I'm more on the buy side. We're not adding to it because of the risk profile of that portfolio, Harry.
Definitely. Sort of in the same bucket is Pinnacle, PNI. It's a stock we owned in the emerging portfolio, did really well out of. That sort of whole basket of stocks has pulled back, sort of as a result of Magellan. There's a lot of other factors at play, James. But are we going to take a look at Pinnacle again here?
Yeah, absolutely. So I think I'd encourage you to look at it in your emerging companies portfolio again. If you think of, we've written about it recently, and I did flag that I don't think it's worth that 25 multiple that is trading on at the moment when you've got a wider sector that's trading sort of 10 times. So Magellan sub 10 times. Some of the other players are around that 10 times earnings. The whole sector has been hit hard. The whole sector is cheap. Pinnacle has traded down from $19 to about 11. It's still on 25 times earnings, but those earnings are growing and they are attracting funds under management across their affiliates. So this is a company that invests in other more boutique fund managers, does a lot of their distribution and a bunch of other back-end services for them. They own equity stakes in them and they back really good managers. So to me, and they're backing managers in equity, in debt, in bond managers, they're all sorts of commercial loans. They're backing a lot of different managers right across the spectrum. So to me, that reduces the risk of backing one individual stock picker or having one individual stock picker that your fate is tied to. So I think I'm struggling to see where I'm still struggling around valuation, but I think it's a really good business model that's growing. And it has, almost halved in price. So we're definitely looking at it. Whether or not we'll pull the button right now is another thing, but it's definitely one to put on your hit list.
Awesome. Thanks for that, James. Let's get back to reporting season for the start of the year.
Always a busy one, Harry. Yeah. And we're only the first week into it.